please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
August gathering today, but I'm equally aware that you're all experts on the subject and would have seen the industry from much closer quarters. The bigger challenge for me, therefore, is to engage the attention. But I must admit that Mr. Parekh, in his candid address, if I may say, has already made my task easier by raising many issues which are extremely relevant. And, it is something which all of you should go back and consider very carefully and seriously. Now, mutual funds have become an important constituent of Indian financial system by channelizing investor savings to the capital market. By the very nature of their market operations that involve continuous buying, selling, and holding various listed scrips or debt instruments, mutual funds significantly impact savings, investments, and liquidity, and in turn, the overall status of financial markets. Against this backdrop, I would like to discuss certain issues that are essential for maintaining, that I feel are essential for maintaining investor confidence in the industry, and also share some thoughts that I believe could be helpful in further improving the regulatory framework for mutual funds in India. And the issues touched upon by me in my address are illustrative and by no means exhaustive. Much has been said about the growth of the mutual fund industry, starting in 1963 with UTI and where it is today, so I need not actually repeat that. But this change in AUM, which has been said over the last 2 years increase, if it's the last 4 years, it is more than doubled. And what is more encouraging, of course, is that number of folios, which in the last 1 year itself, also if I compare, they increased from 7.59 crore in July 2018. They increased from 5.99 to 7.59 over 1 year, increase of 27% in 1 year, which is really very encouraging. And all this campaign of mutual fund sahi hai towards equity participation by retail investors is something which is making it a mass movement, which is really very, very encouraging. And despite this growth, as also said by previous speakers, AUM accounts for only 11% of GDP. So, and as compared to US, where it's more than 100%, or world average, if I heard Mr. Parekh rightly, about 62% or something. So naturally, fund industry in India has a lot to catching up to do, and there are a lot of opportunities for the growth, as has already been presented in presentations by AMFI. So I will straight away go to the issues and challenges which I feel are relevant to the industry. First is, let me start with the concentration issue. It is a cause of concern that despite such tremendous growth, majority of market share of industry remains concentrated in a few big players. The top 4 mutual funds account for almost 50% of industry AUM, and top 7 mutual funds account for around 70% of industry AUM. Concentration in the industry is evident not only in the AUM figures, but also in the revenue and profit margins of mutual funds. It is observed that share of revenue of 7 large AMCs is more than 60% of the total industry revenue. Profit margin, that is PBT as a percentage of revenue of large mutual funds, has also stood at a very healthy rate, somewhere between 40 to 50%. It is therefore apparent that large AMCs have a fairly high market share of total AUM, revenues and profits for the industry as a whole, indicating a high concentration of the industry in few hands. Is this concentration due to lack of adequate competition in the fund space? Are such disproportionately high profits due to high TERs, especially in equity funds? You would appreciate that from overall industry perspective, an industry which is growing and which is likely to grow much more, as has been rightly said by the previous speakers, some thinking perhaps is required to bring in elements that facilitate a healthy competition in the industry, which we feel is lacking as of now. Second, the issue of risk management and valuation. As the industry gears up to move to the next level of growth in terms of size, aspects of risk management and valuation become even more important. And let me dwell little bit more on this issue.
Okay, so that is the SEBI chief who is talking about at the AMFI Mutual Fund Summit of this year, and talking about the concentration really which is taking place in the mutual fund market at this point in time. So we'll keep getting you more incremental updates from that speech, but we need to talk about the markets now and kick off Trading Hour. You're watching Trading Hour on CNBC TV18. I'm Ekta Batra, and with me joining in soon is Prashant Nair. Well, it's turning out to be a day where the Nifty is just about consolidating, but the real action seems to be in terms of what's happening with the mid-cap index as well as the Bank Nifty, both of these indices which are currently underperforming quite starkly as compared to the Nifty and the Sensex. A lot of stocks at fresh 52-week highs continue. So, for example, we have this whole consumption theme which is playing out with Nestle, Dabur and the others at fresh 52-week highs, and from the Nifty space, Axis Bank, Cipla, Sun Pharma, all of these stocks seeing incremental gains. But the other piece that we're following very closely is what's happening globally. One of the statistics is that the US bull market has now become the longest on record. Prashant is here to give us a couple of these facts. Prashant, over to you.
As of the overnight session yesterday, I mean, this is now in the US the longest ever running bull market. I mean, you know, the numbers are on your screen. This is data from the S&P Dow Jones indices, and the numbers are pretty stark. I mean, look at, you know, where we are tied. So, you know, the dates that you see right at the bottom of the screen are the absolute lows. I mean, so that's the clarification. So this particular bull market began on the 9th of March 2009. That was the absolute low. I think it was about 660 or so on the S&P 500. And from there, you know, we've had an unbroken rally. And how are we defining unbroken rally? Basically, we've not had over a 20-odd% decline through the course of the last many years now, which is basically from 2009 to 2018. It amounts to about 3,453 days. I mean, basically, we've surpassed the rally we saw from the lows of 1990, which is essentially, you know, the third bar that you're seeing on your screen from the right-hand side. That bull market began in 1990. It went up all the way to the peak of NASDAQ, which was in 2000. That continued for about 3,452 days. And as of yesterday, we basically have surpassed that by 1 day. Now, I mean, you know, of course, if a big sell-off happens, etc., then we are tied. I mean, something happens later today in the US and something big has to happen. We are tied. Otherwise, I mean, this is poised to take out. It's already taken out this record, and it's sort of on track to make newer and bigger records. In terms of returns, you know, this bull market, which is now the longest ever, it actually pales in comparison to the 1990 to 2000 and odd bull market. I mean, this we are up about, the S&P 500 is what we're tracking here, is up almost about a little over 300%. In the 1990 to 2000 bull market, unbroken run that we saw, I mean, the market went up, the S&P 500 went up about 400% or so. So, I mean, you know, just putting the data out there for everybody, they say markets move in cycles. I mean, time is the ultimate sort of, you know, in a way, decider, and it does weigh on things very broadly. There is a big time overlay. But they also say that bull markets don't die of old age. It usually is something or the other, more likely than not, inflation which kills it, of which we don't have very much evidence in the US, although we are seeing rate hikes. I mean, there is enough to go into this as far as the subject is concerned, but limited point. I mean, you know, as of overnight, the US market cycle, this particular bull cycle, is officially the longest ever. Ekta, back to you.
Okay, all right, Prashant. Thanks very much for that. And remember that there are a couple of cues to watch out for in the US markets when it comes to politics, as well as the Fed's Jackson Hole Symposium, which kicks off today, plus the trade talks between China as well as the US. A lot of cues and news to watch out for from the US. But let's get talking technically then. We have Mitesh Thakkar joining in to tell us what he's strategizing this Thursday. Mitesh, over to you. Nifty absolutely flat with a negative bias, but the real pressure is in the mid-caps and the banks.
Yeah, I think banks slightly look tricky to me, Ekta. My sense is that trading below 28,120, I think, means that there could be some profit booking in banks. and 27,850, 27,750 are two levels which I'm watching on the downside, which could be tested. So it's not looking like a breakdown, but banks typically, if you see, have been underperforming given the fact that stocks like Kotak Bank, HDFC Bank are not making fresh highs as the Nifty continues to do so. So maybe trading point of view, some more shedding can happen over there. But broadly, it looks like a market which will be sideways, and after having seen a good run in the last 5-7 sessions, I think some consolidation is being called for at higher levels.
Okay, stocks, Mitesh?
Yeah, I have one from the pharma lot. That's Lupin. I think is again picking up steam. So that's a buy with the stop at 890. Look for targets close to about 930 here, and also a sell on Indian Bank. Keep a stop at 339. Look for targets of 321.
Okay, all right, Mitesh, we're going to let you go on that note. Thanks very much for joining in and taking us through those strategies. We have Shubham Agarwal joining in with some of his calls as well. Shubham, over to you. Stocks as well as index call.
Yeah, good morning. On the index, Nifty, if we see, then Nifty has been indicating some kind of a bearish bias approximately around the highest call OI, which was placed at 11,600. And today is a kind of a reversal day where we did see a strong opening and then the gains have been given up. So we feel that there should be some pullback in Nifty. So with that view, we recommend a bear put spread on Nifty. The trade would be to buy 11,550 put and sell 11,450 put. The current spread for the strategy is at 31. The target for the same would be 60 and the stop loss has to be kept at 15. The second strategy is on a banking stock, that is PNB. We have seen Bank Nifty being under pressure and most of the banking stocks from the mid-cap space have also started declining. So if we look at the OI behavior on PNB, in 75 strike put, there is unwinding happening, which is indicating that the stock might see some more pressure and it might move down. So with this view, we recommend to buy a put option for the strike price of 80, which is quoting at around 1 rupee. The target for the same would be 2.5 and a stop loss has to be kept at 0.5. And lastly, the third strategy is a bullish strategy on Maruti. We did see that Maruti was in a downward sloping channel for quite some time, and now we have seen a breakout happening there. So we recommend a ratio call spread on Maruti. The trade would be to buy a 90-200 call option and sell 2 lots of 9500 call option. The current spread for the same is at 42. The target spread is 100 and the stop loss has to be kept at 10.
Okay, all right, Shubham, we're going to leave it on that note. Thanks very much for taking us through all of those strategies. Just want to point out Divi's Labs, that stock is at a fresh high today, fresh 52-week high. That stock is up another 4%. And I say another 4% because the stock has already rallied 10% this week. So fresh 52-week high for Divi's Labs, building on gains, 1,300 rupees for that particular stock.
All right, 7 points lower on the Nifty, flat 11,564 is where we are. Let's look at commodities. What's happening? Manisha is here with a roundup of all of that in the commodity space. Manisha, morning.
Morning, and thank you so much for that, Prashant. All the cues really seem to be coming in from the global markets, where we are looking at the US dollar steadying a bit. There is now a 96% probability on the CME exchange of an interest rate hike from the Fed in the coming month. Apart from that, it also has to do with the US-China conversation, which doesn't really seem to be going anywhere, especially as there are conversations going on. You have both the countries hit each other for the second round of trade tariffs here. The total now stands at $50 billion worth of goods from both the countries, and the expectation is that when these conversations conclude, it's only just going to be about a joint press conference about perhaps more talks following, so that really doesn't impact anything that is going on the ground in sense of trade war as of now. That has strengthened the US dollar, and we have seen the metal space actually weaken. So the base metal prices are trading in the negative, and so are gold and silver, especially ahead of the Fed meeting in the month of August. So it has been 19-month lows for the global markets, 8-month lows in the Indian markets as well. How are the Indian markets reacting to that? For that, let's get in a view from Surendra Mehta of IBGA, and he joins us on a phone line. Mr. Mehta, hi, thank you so much for joining us. The last month, of course, has been slightly positive when it comes to Indian gold import. The IIJS numbers have showed a very positive trend as well. But what's your sense on the on-ground buying, especially as one of the major important southern state has gone through a natural calamity?
True, Manisha. It is true that Kerala has seen the biggest flood in the recent times. But this is a temporary effect. It happens at least in one of these states every year in the country. So I don't think it is going to impact majorly to the gold market. Yes, the demand in the Kerala state can go down by about 10 tons or so, but not beyond that. As far as the numbers of IIGS is concerned, we have seen the whopping sales in the IIGS. The visitors exceeded almost double than what visitors were there last year. The sale has been tremendous. We are seeing a very good sales in the rural market, and this is continuing to happen. We are also holding the Zaveri Bazaar festival in the month of October, and with the number of registration going up, or the visitors registration going up for the Zaveri Bazaar festival, this is also a B2B segment festival. We are surprised, and I'm being very positive about the gold market.
What's your sense with the rupee hitting newer lows? Almost every week we've breached 70 yet again today. Of course, there has been a cushion for the Indian gold buyers, but what is the trend that you're looking right now? You said the rural demand was good. The IIGS numbers have been positive. Do you see a definite shift in sense of portfolio holding now for gold?
See, it always happens. Once there is the fluctuation in the rupee, then the entire attention is towards the US dollar. But once the US dollar settles, the rupee settles, the focus again shifts back to the gold. If you see, just last week, the Central Bank of the Russia added about 26 tons of gold in their reserve. So these all clearly see that, again, all the countries are moving towards gold as a safe haven. And so the consumer will also move towards it. So we expect that in India, at least, looking at the US dollar conversion rate, I expect that gold prices can touch to about 32,000, which can give at least 7% return from here to till Diwali.
All right, Mr. Mehta, we'll let you go at that. Thank you so much for joining us. So those are, of course, very bullish cues again coming in from the Indian markets, where the gold buying has picked up not just in the rural India, but in the metro cities as well.
Okay, all right, Manisha. Thanks very much for bringing us that update. We need to take a break now, but up next, we have Dilip Bhatt and Ajay Bodke of Prabhudas Leeladhar joining